What is up, YouTube? How are you guys doing? I hope you guys are having a good weekend. I just wanted to drop in here and give you guys a quick breakdown of all of the trades that we took this week on our Discord community, and also give you guys the play-by-play behind every single thing, break down the psychology, and kind of just give you a lowdown on what we go about weekly with our community, as well as provide some insights. I hope that this video will, possibly give you a good learning experience into understanding what it takes to prepare ahead of a week of trading, and also give you some insights on just the way we manage risk. Those are probably the two key takeaways. I received a lot of DMs after the last pre-market live stream, and remember, if you want to tune into those, it's every Monday, Wednesday, Friday, 30 minutes before the market opens. I wanted to kind of provide the color so that you guys can understand what we go through here. So let's just jump in really quickly into understanding how this week has gone. And prior to this week, we sent out a newsletter, which we always do every Sunday at around noon EST. Kind of outlining what we were expecting for the week. It was a huge week this week. We were planning for OPEX, which is the quarterly expiry of options, as well as CPI data that was going to come out on Tuesday, and then Wednesday with the Fed meeting that was expected with the 50 basis point rate hike from the Jerome Powell and company, right? And so just as the game plan before the week started, I put out this blurb on our Discord outlining the importance of patience, and also that we were at a very crucial part of the market. In our honest view, this was a very difficult week to trade before even getting into it, and we were very aware of this. And so we already knew that there was a possibility for this to go either way. It was going to be a coin flip kind of a move, and just heading into that, we had already briefed that take extra caution this week while trading, mainly because Powell could come on and say anything, and that's exactly kind of what happened. We were already expecting that. So we outlined two scenarios, the bullish and the bearish scenario, with the PPI and CPI, which came out. PPI came out the week before, and then CPI came out on Tuesday. CPI was cooler than usual, and the market seemed to like it really much, but then at the same time, right when the market opened, we reversed. A lot of profit taking ensued. Traders weren't that confident into the FOMC going into the next day, and so it was more of the sell the news kind of an event, which kind of caused us to go into that squeeze at 41.50, which we've been outlining on the newsletter. We stopped just shy of 10 points, about 41.40 for the week, and that was a really great target for us to possibly enter short, but we didn't enter short at that moment, mainly because we were waiting to see what Powell would say. The next day was a full day of pretty much sideways movement, and then when Powell's speech came on and the press conference came on, that's when the market kind of decided, okay, you know what, we don't really like this. There was a lot of uncertainty building behind it, and his comments were very wishy-washy. So a lot of the market sentiment on that day was very confusing. And then come the next day, which was Thursday, pre-market, we saw a big wave of selling that led into where we were for the week. So we already had the bearish scenario in play then, and we were talking about the possibility of the market pricing in another 75 basis point rate hike over the next year. Which is now the case. So that's a really good forecast that we made in hindsight. And so it's really important for me to explain that this all takes a lot of preparation. Being prepared with all of the different outcomes and then having a playbook behind it is probably the most important thing that you can do for yourself every weekend. I myself spend at least a half a day or sometimes even a full day between writing the newsletters, doing my own research, planning the trades ahead of the week, so that I can get the game plan in advance, prepared for our community, and then also, of course, distill all the information for you guys. So without ado, let's jump into all of the trades that we took this week. After we had the bearish thesis outline, let's go through all the trades that we took. Remember, as I always like to say, take these with a grain of salt, because I've tried to outline it with the best that I can. And for this week, we closed out nonetheless about $55,000 in profits. It is not a fluke, or it's not something that I would say happens very often neither, but it's very important to outline how it happened, and also outline how we can possibly prepare ourselves for days like this in the future. Very importantly, it doesn't mean that I hit a $55,000 week. That means it's always going to happen. That's not the case. Always remember, you have to humble yourself, keep your ego low, and remember that anything can happen in the stock market. You just have to be prepared with all of the outcomes. So this week, to start it off, we kind of had a lot of overheating. And honestly, on Monday, I didn't take much trades. I think mainly the main bulk of the trades started on Tuesday. Monday, we might have taken a couple of trades, but they weren't really that many trades to begin with. Mainly just a Netflix put scalp, which I'm going to go through in a second here, and then an Apple call, which I swung into CPI. So let's go through those two trades first. This was pretty much on Monday, heading into Tuesday, and then these following on. I'll start to mark the days from now on. And that will be for the future. So I'll fine tune this process of breaking down the trades every week for you guys, so it's easier for you to follow and understand what happened when as well. So let's jump into it. So Netflix was the first trade that we took on Monday. This was a put trade, or rather a bearish trade opportunity. And we took it for the 310 strikes. I'm going to jump into that chart real quick and let's go through it. So very important thing to understand at this juncture was that when we came up with this trade idea, Netflix was trading in a rising wedge. And this is typically considered a bearish formation. Typically, price action is squeezing into kind of a focal point, which is where the highs are getting kind of slanted this way and the lows are getting this way. Shows kind of demand is slanted, and we started to get very heavy rejection at the 331 level after a failed breakout. So after the failed breakout here, this is the first trade that we took of the week. We saw the possibility of a short opportunity after rejection of close to the 331 level, which we've been anticipating for a while. Now, in lieu with this, we had SPX. And this was exactly where that was. This is pretty much where SPX was starting to move to the downside to retest this trend line ahead of the CPI news that came out the next day. So on this bearish kind of movement down is where we decided to take the market cadence trade. This was also the same moment when NASDAQ was kind of bearish ahead of CPI. And we saw a lot of that kind of play out because of NASDAQ. So you guys know, understand, if tech is weak, then that spills over into many sectors. And so on that pullback which we saw, we started to take weakness on Netflix. It was a great trade that started to reject. And so the idea behind the trade was the weakness in tech would translate, and one of the best risk to reward ratio scenarios in that trade was Netflix, because it was trading near a trend line. So there was relative strength in the stock that could now be in risk of weakening, which is the plays that I like to take. I like to take plays that people might be pressing for upside when there is almost close to none. The risk to reward ratio here to the upside was very slim, but there was a very nice risk to reward ratio to the downside. And we entered right after these couple of rejection candles to the downside. Now, most of the trades that I take are all going to be on the 5-minute chart. So I'll try to use the 5-minute time frame so you can see it better. And our entry was pretty much spot on right after these two rejections right here. You could see, and we entered right when we broke this range. Taking the trade, we got squeezed just a little bit, and upon that rejection once again was another entry for adding more size, and we traded that all the way down into this kind of zone here where we took profit. So we knew that we could get to at least 322 or 323, which was this region here, the previous sweep lows. This was also a region where we used to test to go higher the last time, so we knew this would be definitely a region in which we would come down to, and so we decided to play that to the downside all the way there. Remember, one thing is that you don't necessarily have to get all the way straight down here right away, and I always remind the team on this. Whenever you see a gap, whenever you see anything of a magnet point where you think that the trade's going to get to that point, remember that is not a guarantee that you're going to get there. So what you have to do is employ your tactics and your rules of risk management where you scale in and out of your positions. And this is super important. And I also should probably mention that really straight up in the beginning here, that my style of trading is always to take a front load of some risk and then add for it the confirmation, but add some here, add some more here, and then you can scale out some, scale out some, scale out some. And that's the way that you would average in and out of your trade, which will ensure the best average price fill and the best average price fill out. And I think that's just a really good way to structure your trades in a way. So you should probably look at that, or if you don't know about scaling in and out, you should probably read up about it or try to watch some videos about it. And so that was your Netflix trade that was pretty much summarized. After, on the same day, we also played some Apple calls right on the bounce. This was pretty much the first bounce here out of this bottom. Apple was trading in a pennant on the 4-hour. It was a very, very classic pennant style. We were bouncing from that bottom of the pennant right here, and we decided to play this to the upside for a possible retrace to the upside after the indices were also possibly bouncing on this little bounce on the trend line here. We were expecting a squeeze. We saw the possibility of a squeeze with the gamma exposure being flipped intraday through the options chain, and that's the reason why we took that Apple trade. So heading into that, we pretty much entered that trade along here, which was on the bottom right there. And it started chopping around for a little bit, which is where shortly after I closed out the trade for a very small percentage of profits at 8%, because I didn't want to get trapped and the momentum was starting to die, which is, I'm going to add the second lesson here. So I'm going to keep adding lessons and peel the onion with you guys, adding the lessons along the way so that you can understand what the thought process was behind. Why did I exit at 8% here when it ultimately ran up the end of the day? The thing about my style of trading is I always want the move to happen immediately, and if it doesn't happen that way, I will temporarily exit if I see momentum start to slow down. So my main exit strategy here was after seeing this big rejection candle with the top wick, I thought that the price action was a little bit weaker, and I decided to exit. Now, granted, after that, we started to move higher and higher, but I managed to catch a bigger position right after that to play the upside after realizing that I may have gotten stopped out or I may have gotten spooked. So I re-entered the position, but with a little the same size and roughly the same entry. You can see about 238, 237, about the same fill. And what happened here was I actually this was a fluke trade, and I'm being super honest about it because that's the way I have to call it. What happened was I set the trade long, and I had gone to sleep, but I had put a limit order on this trade to exit at around $3.50 because I was expecting Apple to run up, but I wanted to go to bed, and the limit order never filled. For some reason, the limit order never filled. I don't know what it was or what happened, but the limit order never filled. What happened with this trade and why the profits were so big was mainly because it didn't get filled, and the next day, pre-market was PPI, it was CPI. And CPI came out positive, and Apple gapped up huge. It gapped up way past 148, which was the strike that I took. 148, which was $4 in the money from the strike that I took. And so that's the reason why there was a huge 178% gain on this contract. So with these two trades, with the Apple one especially was more of luck, but Netflix was a scalp on the day. So this smaller Apple trade was also a scalp, but didn't really play out that much. So I've indicated what the trades were, what kind of trades they were right here in this column. Hopefully it's easier for you guys to follow along as well with that. I'll try to make the format a bit cleaner in the next video, but I just want to make sure that we get something out this week so that we can at least give you guys some value here. Okay, then next up came semiconductors, which was a swing trade that we have been talking about for a while. If you've been following newsletters and you've been following the pre-market live streams, we've been talking about semiconductors going bullish for a while. This was a trade that we entered pretty much on the bounce of this retest right here. And once again, call it luck, but I took the trade for a swing to the upside the next day, knowing CPI was there. I was planning to hold it for a while because it was January expiry, and the next day it gapped up huge, and it pulled back pretty much somewhere in between these two candles here is where I exited the trade, and I had a stop loss running on it. It was a GTC order, which was good till canceled, so it pretty much stopped me out. After the market opened, I set the stop loss and it stopped me out right in between there. I was happy with the profits, so I took it off. I scaled out some of it at 46% and then got stopped out the balance half of the position at 51% after that, which was a really great trade. So this was a swing trade that paid really nicely. And then we had Nvidia and Microsoft, which were two bearish trades that we took. I believe probably the same day. And these were interesting. So let's do Nvidia first. And Nvidia was a great one because we saw relative weakness in Nvidia on the same day after CPI. So this is post CPI gap up, and we saw weakness in SPX and Nasdaq on the same day, you can see this was the weakness that we saw, and we saw Nasdaq break below the key bearish pivot, and so we thought this was a great day to short the two stocks that had the best relative strength heading into CPI. One of them was Microsoft. If you go back and you look at Microsoft, it had been on a very, very deep run ever since it kind of peaked out of this falling wedge. And Nvidia was the other one, which had a lot of good relative strength, ahead of CPI. So it had been in this very big uptrend, broke out of it very bullishly after CPI, and so we took this opportunity to short Nvidia and Microsoft into the weakness of the market, which is what you should be doing, following the cadence of the market, seeing where the possibility of that is weak, right? So very simple range break entry here on Nvidia. The break below this low here at 185. I believe we played some 185. Yep, it was at the money contracts that we played. The entry was around 370. This was a day trade. We were pretty much just looking at exit, and so you can see this, and this is the same trade. Pretty much the same entry, 370, 370, 370. And so then you'll see three exits. Those are the scales out. So one at 42%, the other one at 61%, and then the other at 68%. And so that's how I typically take these trades and play them. You can see the entry was made pretty much right at the break here in between these two candles. And then we exited one right when we got close to the low of the day. And then once the pullback happened and we broke further down, I took another contract off right after about 10 minutes. And then the final contract on this push down. Another lesson that I'll interject here is, which I always remind the community, is this: whenever you are trading, always remember that your aim is to exit your contracts on red candles if you're taking puts, and take exit your long trades on green candles. When the market's pushing up, people are willing to pay extra prices and sweep contracts, versus when you're trying to get out of the contract, if you see a long trade and you see a red candle come out, or when people are selling their contracts into a red candle, your implied volatility of those contracts are going to start to dump. People are all exiting at the same time. That's not the strategy you should use. And I know some of you are going to be saying, oh yeah, but what if it keeps running higher, right? Well, that's part of the planning that you have to take. You have to stay disciplined, you have to follow your strategy, and you have to always remember that you can't always time things perfectly. So your strategy should always be leave some runners on the table and get majority of your position out, right? I always like to remind the team and say, if you're eating a fish, you want the most juicy part of the fish. You don't want the head, or you don't want the tail. You always want to eat the middle where it's the juiciest, and let the vultures eat the tail and eat the head. Where people are trying to chase and FOMO the bottoms and the tops, you should be eating the move in between, right? And if you can do that consistently, that's what's going to make you successful as a day trader, all right? So that's the strategy that I employed here. Entry here, exit, 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 exit 1, exit 2, exit 3. Once again, no guarantee that you'll gap fill all the way down here. Some people like to get ahead of themselves. The greed sets in, right? And you start to think to yourself, oh man, what if you're going to go all the way down here? That's going to be such a great profit in the trade, right? But it's not guaranteed. Remember that. So always take your profits off the table where you have them. All right, that's what I'm trying to go here. So that was your Nvidia trade. And Microsoft, very similar setup into the relative weakness of the market after strength there. We took it on the rejection right after it formed the bear flag. This was a much kind of a later trade. It wasn't at the same time as Nvidia. So it kind of went into a bear flag here, and then after that got rejected and came down after that. So we took the opportunity on this pullback off the bear flag to take the entry into the short position and exit the position right here. Now, you'll realize on this Microsoft trade, and I remember this very specifically, I set a stop loss. So you'll see Microsoft here, Microsoft here. So two entries here on the journal. Why? They were both the same entry, but two different exits. And you'll see one of the exits are significantly less in profits than the other, almost half. Why? Because I got stopped out by my stop loss. Now, one thing that you need to always remember is when you're in profits, secure your profits by moving your stop loss to at least break even. And if you're already at something like 40 or 50%, your stop loss should be in profits, which means you should move your stop loss up to 20%, 30%. So in this case, I had my stop loss at 20% already, securing the bag for a minimum of 20% on the trade. That's the reason why I got stopped on that trade. And I was happy to take the bag. Okay, $875, that's great. Did I enter again? No. because I was expecting if we did bounce here, then there's possibly that we will go bounce for this the same movement, and indeed we did bounce after that. This was that move on the SPX into the end of the day. So that's what we were looking at here, and that's the breakdown for Microsoft. Next up was Tesla. These two were scalps. You can see very small percentages on this one. I also didn't go crazy on the risk with this one because the market was being extremely choppy. So this was 155 put entry, and you'll see it right here. This was actually kind of a fake out move, and I didn't really like this one that much. Let me just show you really quickly here. Yeah, so essentially what happened was Tesla had been ranging for a while, and I think you guys remember this, but Tesla has been ranging for a while. It kind of broke below this price action here, and we were looking at this rejection of the 38.2 extension, and right at the break of this 155.92 level or 156 level, I wanted to take a short trade, but then guess what happened? We didn't really get much relative strength into it. I did manage to capitalize just a little bit of this price action, but I got stopped out, and I decided to exit the trade because it wasn't moving in my way. That's the reason why it was such a small amount of profits, 13%. And honestly, from a risk to reward ratio standpoint, this scalp wasn't the best. But then again, you know what? Sometimes you're not always going to perform the best. So in my opinion, this trade could have been the one thing that I improved on this week. And so this is the one trade that I'll highlight as that has a lot of room for improvement, especially with the scalp procedure that I used. What would I have done better here? What I would have done better is wait for that breakdown to happen and have it start rejecting this backtest level at 155, which kind of happened later on. But once again, Tesla moved very, very erratically the whole week until pretty much Friday, right? Thursday and Friday. So in all honesty, I should have probably waited for a bit more confirmation here before taking this trade. But I did see, some flow coming in, and that also probably played the back of my head. And so this wasn't exactly the best trade that I took this week. But all in all, you know what? You can't always have it the best. You just got to manage your risk. As long as I cleared green there, I was happy. I took a small profit and I moved on. Next up, SPX. So this one's going to be broken down into 3 separate orders here. This is going to be these 3 right here. There were 10 contracts in total. This was a swing trade that I took after. This was after the Fed meeting. Okay, so this is almost heading into Thursday now. So Thursday, all right. Pretty much before. After FOMC, but the day before pre-market, which I spoke about. This was also alerted on the Discord community. I believe I put it here. Yeah, so this was right here. So you can see 12:15. This was pretty much on Thursday, right? And you can see, obviously, I'm in Singapore, so I'm ahead of you guys by 16 hours. But for me, that Thursday is your Wednesday. So this was after FOMC, right before I went to bed. This is very close to market close timing, okay? Almost 30 minutes before the market closed. I took SPX puts as a hedge, and so this was the trade right here. You can see 39.20 entry, 39.20 entry, the same trade that was taken, and we took a starter. I took a starter size. So this was supposed to be a hedge against my entire portfolio, and rightfully so. The next day, that was a beautiful move. So we entered somewhere around here, pretty much. Right when it started chopping around, we entered, and the next day it opened up beautifully. I managed to take very nice profits on this trade. And I exited it in pretty much 3 stages. The first time that I exited it was only for 19% because I wanted to secure profits right off the bat. That was a move down early in the morning, and so I secured the bag right here. Very small move, and then the gamma started to build in this trade, and the second exit was right here, right after we got a little bit of further dumping after the pullback. I exited one more round right here. And I believe that the third one was somewhere down here as well. So it was pretty much between these 2 points right here on 39.10 or 39.05 all the way down into 38.80. These were the 2 points right here. Upon the rejection of 39.50, that was a very, very key level for me personally, which I was looking at all week. And yeah, so that was the psychology behind that. We already knew the market was going to be weak. I had already written a blurb about this on the trading floor as well, because after FOMC, what happened was everybody was very uncertain about the price action. Not only that, I think a lot of people weren't expecting for Powell to give us a heads up that next year rates are going to be higher for longer. This caused a lot of unexpected moves and unexpected outcomes for next year. And the market hates, uncertainty. So that's what kind of happened there. And that was the psychology behind it. I decided to take the hedge. The hedge paid off. So that's kind of what happened there. These two right here, Apple and Google, were day trades. Very small risk applied here. You can see very, very small risk. These two also spill into these. So you can see they're pairs, right? Same entries and different exits because I scaled in and scaled out. So these two, we'll have a look at it. Apple. This is the second half of the trades, and this time we were trading puts. So you can see this one was pretty much, let's have a look here, 138 puts. That's right. So we were at about 139. We had a gap down. This was a breakaway gap from this range that we saw, pretty much trying to continue into this price action below. And after the breakaway gap, we typically see the index was already pretty weak. So we decided to press the downside. We entered pretty much around here at 139 and exited shortly after breaking the range of the lows on the day. One of the reasons why I exited a little early in this trade is because I was expecting a bounce of some kind. So this is roughly where I exited. And remember, next week I'm going to be better about this, giving you guys exactly the exit. But this is pretty much the range in which we entered and exited. This was all based on the market being weak. I love to play this kind of a strategy where you understand that the market momentum is weak, and you can play on that by shorting the big market cap stocks within the index, which will be moving in accordance. Sometimes, obviously, they're going to go ahead against what you're doing, but majority of the time, it's always going to hit spot on. And so this is the reason why you can see I traded Apple and Google hand in hand. And you can see Google was a simple one as well. Broke down, took that breakaway gap once again, and this shows that overnight we had a consensus change, and right after that we took that short position in there, exited very shortly after that. Remember, no guarantee that you'll keep falling after that, so just secure your profits whenever you can and move on to the next trade, right? Simple, very, very small move there. That's all we needed, and very easy to play that. So those two were day trades, exited that one. And then this was let's see here. Yeah, that was the final one. Okay, this was a SPX scalp for a put to the upside also. In my opinion, I could have done away with this trade this week as well. So this and the Tesla trade, not very proud of these two trades in my opinion. This was a 0-day expiry trade, by the way. So this was on the 15th of December. And this was pretty much an intraday trade upon the range break here. We saw the break below 38.80, and I decided to take a short trade to the downside to play into 38.60 or even 38.40, but that wasn't guaranteed. So I took a short little trade from here all the way into this candle. You can see it's a very small trade actually. The actual distance is probably around from here to here. That's it. The arrow is just signifying which candle it was at. And so you can see it's a very, very small trade actually that was profitable here, and that's the reason why it's only a 14% profit there. But the size on the trade was roughly about 20 grand, which in my opinion, risk-reward ratio-wise, not that great. So Tesla and this one were two of the trades that I'm not so proud of this week. And you know what? This is the reason why we journal, right? This is the reason why you have to journal, okay? It's not just enough to keep going through your process over and over again. You're gonna make mistakes. But at least when you collect the data, and you don't need a complicated software to do this. Look at this Excel sheet. And honestly, if you want this Excel sheet and you want to track your own trades, drop a comment below in this video and tell me you want it, and I'll send it to you. Okay. Or if you want, I'll upload it to like a WeShare or something and share it with everybody. I personally don't mind sharing this journal, and honestly, it's full transparency for me because it tracks every single trade that I've taken this year. And even gives me my yearly P&L on there. So every single trade that I've traded this year, ever since January, we kept this journal. Everyone in Discord knows this. And I've been tracking it accurately. Obviously, the P&L over there is not void of commissions. So this obviously needs to be, we need to deduct commissions from this. And after that, it will align with my brokerage pretty much. So transparency is really important to me. And so we need to always keep it. Now, if you are interested in this journal, hit me up. I'll send it to you. No sweat. There's really no problem with me doing that. It's a small thing. Okay, I will gladly give it to you. There's no gatekeeping here, guys. All right. Then ending the week, I thought I was gonna close green, and then what happened was a bout of overconfidence. So you guys tend to know what happens. You tend to get overconfident towards the end of the week. You know what? I was up like 58 grand. I was like, you know what? I'm going to try and take a couple counter trades here. So I took a Google and Amazon trade. Now, if you look at both of these trades, you might agree that actually they looked pretty good, but in hindsight, I shouldn't have taken them. So this was Google after being sold off, opened the market here, and it started to go a little bullish here. So once it started to break out, okay, so the entry was somewhere here. Once it started to break out of here, I decided to enter a long trade. So you're looking at either one of these two candles right at the range break here. And I saw that the opening volume was pretty decent. But there was no follow through after that. Now, sometimes what happens is, even without follow through, you can actually still catch the bounce play when it comes back. But in this specific case, it wasn't a good trade. It just kept falling after that, and the reversal, and then we started moving sideways. Right when it broke the low of the day around $90, I cut the trade, and I took a 33% loss on this trade. And once again, it's really important to review where you went wrong. And in hindsight, what the lesson from here should be is, when I was watching for that break, I should have waited for the breakout and the retest, and I didn't do that. So this was a very classic beginner mistake that I made, and it's okay. I'm completely fine being vulnerable about what I'm made a mistake with, because that's what's going to help me next week to become stronger. Sometimes you're gonna take trades like that because you're so confirmed with your bias, you get confirmation bias that, oh man, we've sold off so much. That was at least my bias. It was, we're sold off so much, we have to bounce at some point, right? And so I decided to take a counter trend trade, and I paid for it, right? But also there was the other thing in the back of my head, the psychological problem, which was like, oh yeah, I'm already up, 58 grand in this week. You know what? I can afford to take a loss. So in some ways, you might be self-sabotaging yourself, and that's just the reality of trading sometimes. So yeah, that was Google summed up. And in hindsight, next time, what I should have done is wait for the breakout, wait for the retest, wait for that bounce, and then once you get confirmation, you can play the upside further, right? That's not what I did here, so that was a mistake, and so I hope there's some learning points away from that. And then also exactly the same setup on Amazon, which was a mistake, so I'll show you that right now as well. Exactly the same setup. Look at this. Oversold, right, on Amazon, and we were approaching a very key level bounce right here. This has been a very key level bounce for Amazon multiple times. I thought, you know what, opening volume has been pretty decent. I saw some of buyers coming in on the level 2 tape as well. Same with Google, right? And then they just failed to materialize. The trade just failed to materialize. I took it on the break right here somewhere. I think must have been around 88.60 or so. We were talking about this candle right here, around these two candles somewhere here. And then it failed to materialize, and I must have exited pretty much on the break of this right here, so it would have been somewhere in this range right here. And once again, guys, I'll keep a better log of where I entered and exited. This week I didn't do that, so from weeks on forward from here, you'll know exactly when I entered and exit. I'll put the arrow exactly on that 5-minute candle, so you guys will see it. So yeah, that was the summary of all the trades that I took from this week. Now, you would say, wow, that was still a great week, but this is where it gets really important. You copy the journal over. This is obviously, I have a monthly tab here as well, so I just copied all of this over here. And next week we start fresh, right? We start fresh here, so we'll be deleting all these entries, starting fresh. And it's important not to bring this mindset over into the next week. If something throws you off your game, you got to always remember that you bounce back quickly. Don't let it consume you. The emotions of greed and fear are something that can really latch onto you, and it can make your life tormentous. So don't let that happen. When you head into the next week, throw that all behind you. Start the week fresh, and get on there with a new pile of things that you're watching. Understand what's happening in the background of the market. Know the market structure in terms of the macro, the micro. Also look at what the granular view is. For example, what is the exposure of market dealers? These are all really important things, right? And obviously we do all of that for you and distill it on Discord. So I'll put the link if you want to also join the Discord. It's going to be in the description below. We're just a like-minded team of individuals who are just trading together, and as much as we can, we support each other, and it's a very good vibes community. So yeah, that's all I have for you guys this week. Next week I'll come in and put another video out, regardless of whether it's a profit or a loss. Even if I have a red week, I will come in and put the video out. So that way you guys can learn from all the journey that I'm going through. Because remember, it's a never-ending journey of learning. Trading is a never-ending journey of learning, and you're just going to constantly improve if you keep track of what you're doing and where you went wrong and how you're going to improve. That is the only way forward. All right. So till next Sunday. And I'll see you guys then. Peace, guys.